Time now for business. Let's say hello to Kate Moody.
Hi, Francois.
Or should I say hello again?
Hello again.
You've been watching the markets this Tuesday after that biggest single-day drop-off for the Dow Jones Industrial Average. What's the situation at 12:45 and 17 seconds New York time?
Well, New York is having a rocky ride this Tuesday. It all started, of course, on Wednesday, this ripple effect sending across the globe when Wall Street plunged to its lowest levels in 6.5 years during Monday's session. That led to huge losses in Asia this Tuesday, and the ripple effect then continued. European markets slightly pared back their earlier steeper losses. They were down as much as 3% earlier on. Still a tough close there, though. London FTSE 100 down over 2.5%. The CAC 40 and DAX not far behind. Now, Wall Street has been down, and now it's up again. It's all a bit of a roller coaster there. As you can see, not quite the sea of red that it left at after yesterday's closing bell. The Dow Jones has been swinging within a 1,000-point range. What is certain is that the so-called fear gauge, the VIX volatility index, has spiked, reflecting the uncertainty about this roller coaster ride. Now, to get a little bit of insight into what's happening, we're joined by Michael Hewson, Chief Markets Analyst at CMC Markets in London. Michael, I think the $1 million, or perhaps in this case, $1 trillion question everyone wants to know the answer to is, can you explain just what's caused this huge sell-off of the past few days?
Well, not really. I think there's a number of factors that have probably driven it, but I think a large part of the reason we've fallen as far as we have is, I think, simple word, complacency. I think investors got themselves into a mindset that ultimately stocks were a one-way bet. And Friday's payrolls data was, I think, the catalyst, but I think it had been coming for quite some time. And what we've seen over the past few days is markets being caught offside by expectations that potentially central banks could actually tighten monetary policy much faster than they originally priced in. And I think that fed in of itself over the course of the past 24 hours. And what we've seen is markets crash quite significantly over the past 2 weeks. We've seen 6 successive down days for European stocks. The CAC 40 has fallen 8%. It is now rebounding back. The DAX has fallen 10%. And even the FTSE 100 has fallen quite significantly over the past few days. And I think this contagion that we've seen from US markets has spooked investors.
Now, as you said, investors have really gotten used to these record-breaking sessions around the world, really. Is this a new era for global financial markets?
Well, what I would say is I think investors have to get used to the idea that markets don't just go up. And I think this particular move has shaken them out of their complacency. You talked about the fear gauge being volatile. It has been volatile. It's been up to 50, down to 22, back up to 40 today. And I think that reflects the uncertainty at the moment that markets aren't a one-way bet. Have we reached the bottom? I think it's very difficult to say. The Dow is now up. It was down 567 points on the open. We've had 1,000-point moves in a single day. And I think that's putting some investors in two minds as to whether to get back into these markets. If the Dow continues on its current trajectory, then I think European markets could well open higher tomorrow for the first time in 7 days. And if that happens, then I think that will be a welcome relief to a lot of investors.
Now, there's been a lot of talk of interest rates in recent days. There has long been a concern that central banks could move too fast in tightening their monetary policy. Why is that concern suddenly manifesting itself now?
Yeah, I mean, I think that is one of the reasons why I think there is a little bit of concern amongst equity investors. And I think that's to do with the differentials between what bond markets are yielding at the moment, particularly in the US. US 2-year yield is around about 2.2% or slightly below that. The 10-year is 2.75%. But if you look at the trailing average dividend yield for the S&P 500, that's 1.8%. So there's a big difference between what bonds are yielding in the US and what US stocks are yielding. That's not reflected in European markets, but unfortunately, because of the interconnected nature of the way markets work, European markets are being caught up in the backwash, if you like. So I think this will pass, but I think for the time being it's going to continue to be very choppy, and we could see a move lower before we see another move lower before we see a stabilisation. I think it's really a case of, if you're an investor, take a wait-and-see approach, see how the markets stabilise, and then move on from there.
Should people be worried about the broader picture, about a sign that the global economy perhaps isn't in quite as good a shape as we've been led to believe?
No, I certainly don't think that they need to read that into it. Stock markets and the economy are not related, despite what President Trump would have you believe. The economic picture still remains fairly positive. I think the stock market rallies that we've seen in the past few months have reflected that. They are forward-looking in nature. I think this correction is entirely healthy. I think it knocks investors out of their complacency and makes them much more focused on where they should be putting their money and not where they have been putting their money in places like Bitcoin, for example, which is very speculative.
All right, Michael Hewson there, giving us a little bit of insight into what's been happening on the global markets. Thanks so much for joining us from London. Francois, I'll be back throughout the evening, of course, seeing what's happening on Wall Street, talking about Bitcoin as well, which Michael was alluding to a little earlier on. It's been plunging, but not for the reasons you might expect. I'll be back with Laura a little later on.
All right, the economy and the stock market, two separate things.
Clear message there.
All right, many thanks for that, Kate Moon.